Please stay tuned for important disclosure information at the conclusion of this episode.
This is Destination Retirement with Robert Kuhn from Kuhn Capital Partners. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Robert provides his clients and prospects the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful strategies to put you on the path to achieving your retirement goals. And now here is Destination Retirement with Robert Kuhn.
Welcome. You're listening to Destination Retirement. Thank you for joining us for the first show of 2024. We want to make 2024 fantastic, and we're going to do our part. Everything that we do, I've made a real strong commitment to education, to financial education. It's not you, it's the advisor. That's something that we spend a lot of time talking about. It's not you, it's the advisor. Our job is to make sure as advisors, at least for our clients and at least to those that want to listen to us, that we craft portfolios that can do well whether the markets are up, whether the markets are down, or whether the markets are sideways. Because yes, you can make money in a down market. And we're going to talk a lot about that this year. If you are interested in tax savings, if you are interested in ways to greatly reduce your taxable income to the tune of $75,000 to $80,000 per $100,000 invested. So if you sold a building, if you sold a business, if you are a high wage earner, if you have significant embedded capital gains, let's have a conversation. We can take advantage of strategies that can greatly reduce your taxable income. The January, so end of January, we are having a dinner. We're going to have a 2-night dinner, so you don't need to come to both nights, but so it's going to be the same presentation each night, but in Naperville. So location and exact dates TBD, but they are getting put on the calendar right now. Who should come to that dinner? Those individuals who want to learn about tax strategies, learn about ways to reduce your taxable income, individuals who want to focus on strategies that can do well independent of the stock market, so strategies that pay distributions and cash flow. So this is for really kind of, I don't want to say it's a down market strategy because, you know, I think it does really well in all markets, obviously, but characteristics are it's not correlated to the S&P, to the market, to the bond market, to the equity markets, significant tax benefits, and low to mid double-digit annual distribution. So if you have any interest in there, give us a call. We'll go over what we're going to talk about to see if it makes some sense for you. The dinner is complimentary. Generally, man, have done so many of these, and we've kind of gotten away from them actually with COVID. But now we're getting back into just doing the dinners again. I think they're just a phenomenal way to educate individuals. Again, it's not you, it's the advisor. Most advisors are failing clients. And if we have a very volatile year, the real challenge is how are you, A, going to still make money, and B, how are you going to protect the gains that you've experienced and hopefully you've had last year? So give Paige a call if you have any questions on the dinner or if you have any questions on your individual situations and you just want to set some time up with myself. 630-492-1912, 630-492-1912, and she'll set that up. And also visit the website. You can do that, kuhncp.com. kuhncp.com. So what I thought we'd do this show, given it's the first show of the year, I think we really need to recap what happened last year and really kind of focus on, what I expect to happen in 2024. If you've listened to the show in the past, you understand that we are really going to hit advisors who are lazy hard. And we're really ratcheting that up because the more people that we meet with, what I have found is that you think you have a very customized portfolio. You think you have a portfolio that can deliver strong risk-adjusted returns. And then what happens is in years like last year, everybody's a hero. I mean, everybody is a hero. We all look like geniuses as financial advisors, right? The markets did what the markets did. They just, were up. And so the bulk of our strategies were up. Some weren't up as well. I mean, there are strategies that, have different characteristics and different types of markets. But what happens is in years like last year, you think your advisor's really earning their keep. And then in years like 2022, well, then, the answer to losing money, not only in your equities, but in your fixed income is, well, you just have to sit and wait. So this year is going to be different. I think we're looking at a period of time in the market that is going to be very, very volatile. I think if you have volatility planning baked into your portfolio, I think you're going to be able to still make money. If you have strategies that pay distribution, that pay cash flow independent of the stock and bond market, I think you're going to be able to still make money. But the challenge is most people don't. So let's take a look at what happened in 2023 before we move forward to kind of what I think is going to happen in 2024. So, I mean, goodness, right? I mean, what a year. And I think obviously the Santa Claus rally end of last year was alive and well. S&P finished actually the last week of the year. It was the 9th week in a row to of positive gains. And, that is one of the best winning streaks since 2004. And so you have to think about that. So, what a year for the stock market last year. We entered the year actually with nearly all economists predicting a recession and predicting a negative market and predicting a lot of doom and gloom. And we did have consecutive quarters of a negative year-over-year earnings growth. That, certainly was accurate. Inflation was stubbornly high early in the year, and the Fed definitely maintained, the rate hike mentality, the rate hike program. But the market also faced a regional banking crisis, as well as wars in Ukraine and the Middle East. And that started to change things. And that started to really, I think, adjust the way that the Fed was thinking. And so we had interest rates that, they paused. And I think they started to, they definitely started to indicate that they were going to be in somewhat of more of a dovish stance of starting to reduce interest rates. And, just because you hear people say, and you hear very, very, very highly credentialed and top ranked analysts say something, that doesn't mean that ultimately that is going to prove out, because we've heard over and over again how last year they were going to cut rates. And we're starting to hear that again this year on how they're going to cut rates. But there is a growing worry on Wall Street that the stock market is way ahead of itself as 2024 begins. And that's a concern of mine. It's a concern of mine because I don't think that investment advisors are positioning clients' portfolios with strategies that can do well, whether the markets are up, whether the markets are down or sideways. And a growing number of observers are concerned that really the stock market has gotten ahead of itself. And as we start the new year, we're seeing a lot of that volatility come back. And if you incorporate volatility planning, incorporate volatility strategies, then I think you're going to do really, really well this year, no matter what happens in the market. And one of our focuses is to be able to advise on individuals' 401k assets. So if you know us, if you've listened to the show, we work with clients who have, $100,000 to invest, and, individuals who have 15, 20, 30, $40 million net worths. And so our job is to really work with those individuals that need help. And there's a huge segment of the population that a lot of their money is tied up in their 401k. And you are really stuck to manage that money on your own. And I think that's a challenge. I think it's a big challenge. And if you have a 401k at Schwab or Fidelity or Empower, there is a good chance that we can help you manage that money. And while it still stays in the 401k, but it's just putting some real science behind offense and defense, playing offense and defense. And so what I've found is individuals especially here in the Chicago market, if you're with Fidelity, Schwab, or Empower, that we can really help you. So if you have a 401k there and you want professional money management inside of your 401k, that's not going to cost you any more than what you're paying now, because there is embedded cost inside of the mutual funds inside of a 401k, make sure to give us a call, 630-492-1912, 630-492-1912, and we want to have that conversation. We are running in multiple markets, so we are headquartered in Chicago. We have offices throughout the country. If you can hear my voice today, then we can work with you. So don't hold back just because you see a 630 area code. That is where all the calls go to our home office, and then ultimately they are dispersed. And so if you can hear me, we can work with you. So yeah, stocks are coming off a surprisingly strong year. All three major indexes netting double-digit returns in 2023. The S&P 500 actually registered 9 straight weeks, like I mentioned earlier. I think that's very, very critical because that hasn't happened since 2004. And so whether, when we look at trading and we look at investing, there's a lot of ways to look at, kind of technical indicators. And there's always, an argument on Wall Street, one of the things that I want to make sure that I hit almost every radio show this year is that just because you're playing offense and defense doesn't mean you're trying to time the market. I mean, that is a lazy way of an advisor to look at portfolio money management. And again, it's not you, it's the advisor. Just because you're playing offense and defense doesn't mean you're trying to outsmart the market, doesn't mean you're trying to time the market. It just means that you're doing what an advisor should do, which is play offense when there's opportunity and defense when there's not opportunity and there's risk. So whether you're looking at the 50 or the 200-day moving average, there have only been 4 other years in the past 70 years when the S&P 500 ended the year with a longer streak of overbought readings. And so when you look at that has to tell you something. That has to tell you something that, the big question is what next? And when we look at investing, so many individuals are kind of rear view mirror investors and really not only individuals, but mostly advisors, where they are going to place your assets if you are looking for a new advisor on something that did well in the past. And they're doing that because it's very easy to run an illustration and show you that, listen, here's what you would have done if you were working with us. And the news that, you need to understand is that past performance means nothing about future performance. And if there's nothing more evident than that than in small caps last year and what happened in the small cap space. Small caps had a terrible year. They've had a terrible couple years, but you know what? They had a record-breaking quarter. I mean, in many instances, up to the tune of 20 to 25%. I mean, so we have to look at mathematically where do we think we are going forward. So the big question is the stage set for a market pullback? And if we look at it tactically and we look at the setup in late October, coupled with the Fed's dovish pivot, it certainly led to a market surge that now is going to be put to the test. And even those who expected a rally off the October lows, which we did, and I don't think anybody was really surprised by that, we are in extremely overbought territory. And so I do think a reversal of market conditions is very, very possible. We're seeing volatility spike. The 10-year Treasury is starting to go back up again. So, you have to really question the sustainability of this rally. And so, again, the job of an advisor, if they're managing money and it's not a closet index fund, again, what a closet index fund is, you own a bunch of different investments on your statements when you log in, but yet you simply track the market up and track the market down. That's what's called a closet index fund. And I would never pay for that. But unfortunately, 9 out of 10 investors, that's exactly what they are paying for. And so you have to look at it and say, is the advisor bringing any value to the table? So a lot of things that we're going to hit this year, a lot of things that we're going to really focus on education wise. Again, it's not you, it's the advisor, it's the strategy. We're here to help. That's our job. Being independent, being a fiduciary, those are two very big things that, especially if you're working with a big bank or a big brokerage firm, there's a almost 100% certainty you have a buy and hold strategy. And again, it didn't work in 22. It worked last year. Well, what if it doesn't work again? So we really have to put your current portfolio to the test and look at, if we're going into an election year, would you be happy with incorporating strategies that could make money if the markets are down, or strategies that, you can still do 10%, 10.5% with, as long as the markets don't lose 30 to 40%. So those strategies exist. We're going to spend a lot of time on them on the radio show because that's my job. So to help you, give you ideas and make sure that we are doing all that we can. So I want to thank everybody for listening to the first show of the year. If you have any questions or you want to set some time up to have a conversation with myself or learn more about the dinner that we're hosting in Naperville at the end of January, please give Paige a call, 630-492-1912, 630-492-1912. More after the break.
Would you like your portfolio to be more certain in uncertain times? These days, there are more questions than ever. Before we can get to the answers, we have a question for you. What do you want to accomplish? Understanding the bigger picture is the first step to helping you pursue your goals today, tomorrow, and for generations to come. To schedule a complimentary call with Robert, please call 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners. Independent. Big deal. Independent. We're a fiduciary. Another big deal. We're a fiduciary. We focus on strategies that have the ability to do well in markets that are up, markets that are down, and markets that are sideways. It's something that we're going to hit over and over this year. So it doesn't matter if it's your 401k, if it's your IRA, if you're working with another advisor, if you lost money in 22, you made money last year. Let's make sure that you're positioned correctly this year to handle the volatility that many think is coming. Again, it's just an opinion, but we think volatility is coming back, and we think that a lot of the potential easy money is made, especially if you look at where most strategists are expecting the year to finish on the S&P 500. On average, you're only looking at 2 to 3% gain from this point. So again, it's just an opinion, but the key to anybody's success is still making money, even if the markets are down. So if you want to learn about strategies that can do well, whether the markets are up, down, or sideways, strategies that can actually have positive returns in down markets, or strategies that can pay cash flow, in the 9 to 11% range, independent of the market, while providing significant tax benefits, let's have that conversation. 630-492-1912, 630-492-1912. Call Paige, set some time up, and let's have that conversation. Earlier in the first segment about rate cuts, and we think, well, at least the Fed is saying, or it's pricing in, that we may see 3 or 4 cuts this year. We also saw that last year, though, and they didn't materialize. So if we look at history and use history as a gauge, inflation could come back, and could come back in a meaningful way. So a lot of the rally in the end of the fourth quarter, I think, was based upon the market being optimistic about future rate cuts. And I think a question that you have to ask yourself is the market too optimistic about future rate cuts? And again, it's all about the Fed, just like it was in 2021, 2022, and certainly last year. Fixed income, if you're still using fixed income as a portfolio diversifier, as a means of, as portfolio safety, you're still losing money, and you probably lost money over the last 3 years. And so we want to make sure that you have something that is much more stable, independent of whatever happens in the stock and bond market. And that's a real good litmus test on, do I have a good portfolio? Do I have a good advisor? Do I have an advisor that actually manages money? Or do I have an advisor that basically crafts a closet index fund? And remember, a closet index fund is something that it looks like it's very customized because you own a lot of investments, but yet your portfolio simply in years like 22 and tracks the market down, and then in years like last year simply tracks the market up. You should not be paying an advisor to manage money that way. You could do that on your own. So is the market too optimistic about rate cuts? And I think if you look at the stock and bond markets, they really have both delivered, even in the fixed income market, powerful rallies in recent weeks. And I think the move in stocks, it has been broad based with everything from small caps to mega cap techs. They've done very, very well. Meanwhile, yields on the 10-year Treasury bond, they have sharply declined from 5% levels in really kind of mid-October to sub 4% levels, over the last week or so. So I think we have almost every expert investor, economist, financial media pundit. What they're going to tell you is that rallies are tied to the Fed pause. The Fed pause means that they're going to stop raising interest rates and even start to cut interest rates. And I think you have to look at it, and the market certainly is, think that's a very dovish expectation. And we think that, the markets have really gotten ahead of themselves. But I'm not here to tell you that the experts are wrong. But what I do think investors should think about is the market and the economic outlook in a more nuanced way, which is to say, again, the Fed is only one factor that drives stock market trends. And so we have to make sure that when you're crafting portfolios, if you're working with an advisor, I want you to be able to look at your portfolio, and if you cannot point out your allocation that will make money when the markets are down or deliver returns with some sort of a buffer, because like right now we're seeing a lot of 10 to 11% returns that you can get based upon, many bank notes, as long as the markets aren't down 40%. So you have basically a 40% buffer to make 10 or 11. A lot of people would be very, very happy with that. I mean, a lot of people, for some of your money, if you know that I'm going to make 10 to 11 as long as the markets aren't down 30 or 40%, people will sign up for that almost every day of the week. And so if you can't point to a bucket of your portfolio that has those characteristics, or characteristics that can reduce your taxable income greatly, or characteristics that'll pay distributions or cash flow independent of the stock and bond market, then you really owe it to yourself to have a conversation with us, because we look at asset allocation, we look at diversification different. Most people think they're diversified by the number of holdings that they own. Well, unfortunately, it's only equities and it's only fixed income. Whether you have one holding or 50 holdings, it doesn't matter. You still only own two asset classes. And we look at the world so much differently, a much more institutional type diversification strategy that I think you're going to have this year. So 630-492-1912, 630-492-1912. So if you want to have that conversation, set it up with Paige and let's have that conversation. But again, let's be fair. I do think the Fed policy does matter. At the December 12th and 13th Federal Reserve meeting, officials, they voted unanimously to hold rates steady, which was expected. But what came as a positive surprise was the decision to publish interest rate projections for the following year. And I think that's when we started to see the market, not only due to seasonality, but that is really what kicked the market into, hyper growth mode for the last part of the year. And they really penciled in a three-quarter rate cut hike in 2024. And so markets certainly rallied. And I think if you look at what the Fed did, they also expressed fairly clearly that fighting inflation was no longer their sole mission. They're convinced that inflation is coming down. They're convinced that inflation is under control. And history may tell you otherwise. We all spend money, and I'm not seeing inflation come down like many people, at least the Fed is saying that they are. And that kind of leads me to those that are investors that are within 5 to 10 years of retirement, or those that are currently in retirement. When you look at your income strategy and you look at your income maximization strategy, you have to be very concerned with the rate of inflation, and you have to be very concerned with ultimately your purchasing power. And is that dollar going to be worth $1, 3, 5, 7, 10 years from now? And we know that hopefully just because of inflation, and some inflation is good rather than deflation, that won't be the case. But what is it going to be? Is it going to be worth 50 cents? Is it going to be worth 75 cents? I mean, so when we look at the two most overlooked areas of financial planning, first off is tax planning. Very few advisors are bringing you tax strategies that can greatly reduce your taxable income. Also, income planning strategies. Very few advisors are giving you income maximization strategies that can give you distribution yields in the neighborhood of 5 to 10% a year, in some instances guaranteed, depending upon the strategy. And so we have to really focus, again, if we are in a volatile period and we see the markets drop and you're taking money out, what is that going to do with the longevity of your asset? How is the longevity of your asset going to be affected by inflation? And so we have to look at the world a little bit differently today than we've looked at it in the past. So 630-492-1912, 630-492-1912. So yeah, the Fed definitely expressed that their sole mandate isn't bringing inflation down. So, now you're getting back to the point where both mandates, inflation and unemployment, are important. And so, following this meeting, the market seemed to be pricing in not only the possibility, but the probability of a soft economic landing and, the continued downtrend in inflation. And we've talked an awful lot about that. And I think, we talked a lot about that, over, certainly in 2023, which are the conditions that are needed ultimately for the Fed to proceed with rate cuts. But what happens if that doesn't happen? What happens if inflation comes back? And so I think the question investors need to be asking now to their advisor, if you're managing the money on your own, to yourself, you have to be asking yourself now, what happens if the economy grows much stronger than anticipated? Or what happens if inflation is a bit stickier than expected, perhaps, due to a persistently, stubbornly strong labor market and rising wages and spending? What does that do to the Fed's ability to cut interest rates? I mean, again, you have to think about that. And those are things that we are facing that we just haven't faced in the past because we've never seen a lot of this type of, stimulus happen. And so for those individuals that don't think the markets can stay down for longer periods of time, one of the greatest statistics that I think you can always keep in the back of your mind is if you had bought Microsoft in 2000, it took you 14 years to get back to even. Now, if you're an astute investor, you may be questioning, my timing on that, in that, yes, of course, Rob, if you bought it in 2000, we had 2000, 2001 and 2 were down. Then we had the run up and then we had the great financial crisis, right? So are you cherry picking that statistic? Well, not really, because the markets were very, very high in 2000. And so if we look at the probability of what comes next, because I think when it comes to investing, that's all that matters. It's not what's happened, it's what's going to happen. What if we're in that period of time today where people are very exuberant? People think that the markets are going to continue to run. People don't have advisors are not incorporating volatility planning, contingency planning, airbag planning, call it what you want, but strategies that can do well if the markets don't do well. And here's the beauty. We're not asking you to take money market rates of 5%, which are still phenomenal given, where they were, or bury them, your money in the mattress to save, the risk of potentially losing money. We're talking about, in a lot of instances, double-digit returns. Double-digit returns where you're going to get double-digit returns depending upon the investment as long as the markets don't drop 30 or 40%. Again, it's hedging. It's using the banks. It's using the balance sheet of banks that offer strategies that we already know the predetermined outcome. We know that if this happens, you get X, Y, and Z. And that's how we can craft portfolios that can do well when the markets don't do well. So if you look at that 30 to 50% of your portfolio, that might be the greatest bucket of your money to determine your long-term success, to determine if you're going to have stress when you don't want to have stress, if you're going to continue to grow your money, if you're 3, 5, 7, 10 years out from retirement, or if you're in retirement and we do have persistently, stubbornly high inflation, are you going to see your spending power, your purchasing power continue to go down because you don't have strategies in place that can do well and offset, the market corrections? Or strategies that you're paying so much in taxes because you sold a building, you sold a business, or you have, you're a high wage earner and an advisor's not bringing you strategies that you can greatly reduce your taxable income. So those are the things that we're going to talk an awful lot about. So yeah, it's anybody's guess what's going to happen at the Fed this year, but I do think that we had a heck of a quarter. It started the year a little bit more volatile, but we'll get back after it after the break. So give Paige a call, 630-492-1912, 630-492-1912 if you want to have a conversation, or if you'd like to learn about our investment dinner in Naperville and end of January, and if that would be appropriate for you. So more after the break.
Hoping is good. Knowing is better. You are unique, and your investments and plans should reflect that. Investors today want defined outcomes, not investments that simply track the stock market up and down. Did you know most of all mutual funds and managed accounts by prospectus must stay fully invested no matter how good or bad the stock market is? There is a better way. We want our clients to use portfolio gains to compound their investments, not make up for portfolio losses. Schedule a complimentary call with Robert. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president, founder of Kuhn Capital Partners, independent fiduciary investment advisory firm. We work with individuals who want to create portfolios very simplistic that, well, the portfolios aren't simplistic, but the philosophy is simplistic. Strategies that can make money, whether the markets are up, down, or sideways. And the more people that we meet with, the more we see closet index funds, closet index strategies, meaning you think you have customization, but yet your portfolio simply tracks the market up and down, and you're paying for that. So that's not how we want you to manage money. We're going to be very, very aggressive about that philosophy, that term, that topic going into 2024. Again, it's not you, it's the advisor. And so we have to make sure that you have a portfolio that can do well when the markets don't, strategies that can make money when the markets aren't going straight up. So it doesn't matter if it's your 401k, doesn't matter if it's your IRA or just taxable money. We work with individuals that have $100,000 to invest and those that have net worths of $30 or $40 million. So we don't let your investable assets define whether we want to work with you or not, like most advisors do. My job is I have a calling to help everybody. A requirement to work with us is, number one, first and foremost, can we help you? Number two, are you receptive to that help? If you are looking for more of the same, if you're looking for strategies inside of your 401k or outside of your 401k that simply track the market up or down and pay me for that, then we're not going to be a good fit. Again, we want to make sure that we're crafting portfolios that can do well, whether the markets are up, down, or sideways. So give Paige a call. Paige is the firm assistant. She will set you up on our calendar so we can have an initial conversation and see if we're going to be a good fit to help you out. So we do have a dinner coming up in Naperville, end of January. These dinners are going to be throughout the Chicago market, throughout the Florida market, throughout other markets that this radio show airs on. So we want to make sure that you know at least a few weeks ahead of time where we're going to be doing the dinners. They're very educational. So very educational. They're complimentary. This one in Naperville, end of January, is going to be about tax reduction. How can we invest in strategies that can reduce your taxable income by $75,000 to $80,000 per $100,000 invested? How can we still provide strong double-digit returns, double-digit distributions, independent of the returns of the stock and bond market? So if that piques an interest, give us a call. Let's see, and we'll dive a little bit deeper into what exactly we're going to talk about and if it would be a good fit for you. We don't want to waste your time, but if you do have an interest in it, we certainly want to extend the invitation. It is capped, so probably, I don't know what we'll have, 25 or 30 individuals there. So give Paige a call, 630-492-1912. 630-492-1912. And let's have that conversation on your investments, on your 401k, on how we can take strong, most people understand you have to take distributions, RMDs, or if people are taking distributions from their IRA, all of that money is taxed as ordinary income. Well, what if we had strategies that you could invest in that would reduce that tax due, that ordinary income due? Those are the things that we're talking about. What if you have an IRA? Anybody can do a Roth conversion. That's 15 years old or whatever, 10 years old, right? Well, what if we had strategies that could greatly reduce that tax due for doing that conversion? What if you could eliminate that additional income that's going to be you're going to have during that year of the conversion? What if we could do that conversion tax-free, because there are other strategies that can offset that tax due? So those are the things that we want to talk about. So 630-492-1912, 630-492-1912. So let's put an end to Fed and rate hikes. Again, it's anybody's guess, if we're going to have rate hikes this year. The Fed is indicating a 0.75% rate hike throughout the year. If the markets don't get what they want in terms of rate cuts, I think that could drive volatility. And I think investors should expect that. They have to expect that. And if you don't plan for it, or if your advisor doesn't plan for it, well, then it's unfortunate, but you're going to lose money. And, again, it's not you, it's the advisor. It's something that we talk an awful lot about. It's not you, it's the advisor. Do you have strategies inside of your portfolio that can do well when the markets don't do well? We talked a little bit earlier that we're seeing strategies that are very, very strong, strategies that you have a cap on the upside. So again, we talk a lot about the dual directional notes. They're offered by the big banks. So, JP Morgan, Bank of America, Citi, most of the big banks offer them. And you can, we're seeing caps still in the 20% range, where you could still have positive returns as long as the markets aren't down 20%. So when you can tell a client that you could still make money, even if the markets are down up to 20%, they need immediately go to, well, that's too good to be true. No. Again, it's just defined outcome investing. It's hedging. It's the ability of the banks to hedge away risk in ways that you and I simply can't. So those strategies are still very, very popular. A lot of individuals call in for those strategies alone. The distribution strategies, we're seeing a lot of individuals want cash flow, individuals who want to know that for some of my money, if I could make 10 to 11%, as long as the markets don't drop 30, that seems to be a good risk reward on the investment. And guess what? Those investments exist. So 630-492-1912, 630-492-1912. Let's have that conversation and go over it. Because again, our job is to educate. Okay, so let's go in a different direction here. The lost decade, it's something that we don't talk enough about. And I think you have to look at, what is the probability of the S&P 500 having another lost decade? Can it have another lost decade? Well, certainly the answer is, of course it can. But what's the probability of that happening? And if we go back to the lost decade, and you, again, if you bought Microsoft in 2000, it took you 14 years to get back to even. 14 years. So to think that you can't stay flat to sideways for an extended period of time, you absolutely can. And that can be detrimental to your retirement. That can be detrimental. Really where I see it being an issue is if you have 5 to 10 years from retirement, it could be a major issue. If we have another lost decade, if you're in retirement and we don't have consistent growth, that can be obviously another major concern for another lost decade. So, what was the lost decade? Well, it's really simple. From 2000 to 2009, the markets ultimately, didn't do a whole lot. And you actually had a period of time, for the first period of time, that the markets didn't make any money over a 10-year period. Yet we had significant volatility during that period. So if you would look at your account statements, you would see, okay, we're up. Well, then, okay, we're down. Well, then, okay, we're up. Well, then, okay, we're down, but we're not going anywhere. And I think that is one of my biggest fears when we meet with individuals, and whether it's a conference call, whether it's Zoom or whether it's in person, My biggest concern isn't necessarily another 2008, another financial crisis, because generally when you see the markets do what they did and you see how they dropped so much so quickly, usually they're bought pretty fast by the institutions and a lot of the hot money, because computers are truly just moving this market. And I think that individuals are just kind of along for the ride. And so much of your success is, is the market up or down? And it's not necessarily trading on fundamentals. And that's very worrisome, because I think if you look at, what ultimately could happen, my concern is kind of a stagflation period where we see higher than average inflation. It doesn't need to be the crazy inflation, but higher than average inflation with lower than historical trend growth. And that's my concern. So could we have another period of time where the markets are very high and they ultimately over a 3, 5, 7 or even a 10-year period don't eclipse, previous highs? I think we absolutely could. And that's a very grave concern of mine, because I know that individuals are not positioned correctly to take advantage of that volatility, to take advantage of when that, whether the markets are, up or down, they're just kind of riding that wave. And it's really, when you look at your statement, whether the markets are up, you kind of determine, do I have a good portfolio? Am I working with a good advisory firm? You can't do that. That's not, because if we had that philosophy, if you determine success of your advisor based upon, the markets being up or down, well, you had a terrible advisor in 2022, right? You had a terrible advisor, but you had a phenomenal advisor in 2023. But did your strategy change at all? In a lot of instances, the answer to that is no. So again, that goes back to kind of that closet index fund philosophy that most advisors are doing. They're masking it by showing you that you're very diversified, that you own a lot of different investments. But again, the average person listening, whether you have 100,000 or 20 to 30 million invested, you really just simply own two things: equities and fixed income. And so that's why you're on that Wall Street roller coaster. So you can't judge the success or your portfolio simply based upon returns. So it's something that we want to talk an awful lot about. You shouldn't be paying an advisor to have a closet index fund. If you want to just simply track the market up or down, don't work with an advisor. Either do it on your own or go sit with somebody at Schwab or Fidelity or Vanguard, once a year, twice a year, 4 times a year, and then just, hope ultimately that the markets go up, and that they go up, and you have strategies that if the markets don't go up and they go down, that you can still make money. I don't think that's the way you should manage your money, but who am I to tell you what to do with your money? But I think, the easy money's made, and I think you have to have a mathematical strategy in place that, is you can just take advantage of what is going on with the computers, because the computers are driving this market. And I don't think it's going to get any better. I think it's going to get worse. So give Paige a call, 630-492-1912, 630-492-1912. Set some time up if we can help you with your 401k or just your investments. If you want to make sure or if you want to learn about strategies that can do well when the markets are down, or how to reduce your taxable income by $75,000 to $80,000 per $100,000 invested, we'll have that conversation with you. So 630-492-1912. More after the break.
Are you considering buying an annuity? Or did you buy an annuity because you were promised stock market-like returns with no downside? If you own the wrong annuity, there is a great chance you've experienced little to no growth over the past few years. In many instances, the insurance agent received more in commission than many have in actual investment growth. If you'd like to learn more about our annuity repair strategy, please call Robert, 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent fiduciary, two very key words, especially when it comes to creating portfolios. If you're working with a big bank or a big brokerage firm, there's one thing for certain that I know. You have almost no active, proactive tax strategies in place that can greatly reduce your taxable income. That is really almost a certainty. And then there's a high probability that your portfolio is going to just track the market up and down, and you don't have strategies in place that are offered by the largest banks. Now, it might be the private bank side, but we have access to them, but strategies that can actually do well when the markets don't do well. You heard that correct. Strategies that can make money when the markets are down. So those are the things that we want to talk about. Those are the things that we want to bring to the table in working with individuals, whether it's in your 401k or it's outside of your 401k. It really is irrelevant to us. If we can help you and if you're receptive to that help, then we're certainly going to do that, especially in 2024, where the markets are probably going to experience significant volatility. So we do have a dinner coming up in Naperville, end of Naperville. Topic for that dinner is tax strategies that can reduce your taxable income by $75,000 to $80,000 per $100,000 invested. So if you're a high wage earner, if you sold a building, if you sold a business, if you just want to pay less in taxes, you want to learn about strategies that are available for you to do that. Strategies that can also pay distributions, generally speaking, in the low to mid double-digit range that are independent of the stock and bond market, then that will be a good dinner to attend. So give us a call. We'll go over what it is and what it's not and see if that would be a good dinner for you to attend. It is complimentary. So 630-492-1912, 630-492-1912. If we can help you in any way when it comes to finances, we want to be the go-to provider. Again, it's not you, it's the advisor. So we want to help. So global stocks saw a great statistic last week. Global stocks saw inflows of just $172 billion last year, the smallest annual number since 2019. So it's very interesting, very, very interesting, because you look at, what is going on in the market, and is there really a lot of money flowing in, or is it the computers that are driving the market up and then selling it off and then driving the market up, then selling it off? It's kind of a rinse and repeat. And if you look at that, I just wonder if we're in that type of a period, how many investors or how many advisors are incorporating strategies that are based upon momentum. And I think, when we look at technology and we look at what it's done to the market, I think that is only going to increase. I think we're going to see bigger highs. We're going to see more sell-offs. So you have to ask yourself, do I have a strategy in place inside of my equity bucket? Because when you craft a portfolio, again, you want a portfolio that you have some money that will do well, whether the markets are up, whether the markets are down, or whether they're sideways. And when you look at the growth bucket, inside of your growth bucket, do you have a buy and hold strategy where you're just at the mercy of the market? So you look at your statement and we're up 1 month, the next month we're down, then we're up, we're down, we're up, we're down, or year over year, but yet we're not going anywhere? Or do you have a strategy in place that can actually take advantage of the momentum? Most of the hedge fund money, or a lot of the hedge fund money, and a lot of the institutional money, they have mathematical models built to be able to track trends. They follow the trends. They don't care which way the market is going, because they can profit in all markets, in all ways. And in one of our managers that we are providing access to for our clients, that you can't get direct by going to them, at least not on the private side, the managed side, has that in place. And if we're in a period of time where you see a lot of volatility, but we don't go anywhere, well, you better hope that you have a manager that can take advantage of that money, or else you're just going to be sitting there being happy 1 month, mad the next month, or 1 year being happy, the next year being, not happy. And that's kind of the market that we're in. So, we talked a lot about inflation. And if you've listened, to me to the entire show, or if you've listened to me in the past, tax planning is way overlooked when it comes to investing. Also, income maximization. When I have a finite amount of money, whether it's $100,000 or whether it's 10 million, 20 million, it doesn't matter what the number is, but how do I ultimately make sure that I'm going to maximize those assets to provide the greatest amount of risk-adjusted cash flow possible? And we do that because if you look at your purchasing power, and we talked about inflation earlier, if you look at over the last 30 years, the purchasing power of the U.S. consumer in the dollar has actually been cut in half simply due to inflation. Think about that. Cut in half. Yet during that same period, the market's gained almost 800%, which amounts to about 7% a year after adjusting for inflation. But have you thought about if you're going to, if you're 5 to 10 years from retirement, or if you're in retirement, how are you going to maximize those dollars? And if we're seeing higher inflation, if we're seeing our purchasing power being cut significantly, and you experience a down market 2 or 3, well, what does that do to the viability of your asset? And that's why it's so critical when we look at volatility planning and we look at, planning for, the markets when the markets don't go up, because everybody makes money when the markets are up. That's easy. A lot of our conversations with listeners or current clients or those people who are interviewing us to potentially manage some or all of their money, it's not necessarily about, hey, how can we beat the market? Yeah, a lot of our strategies destroyed the market over, 10 years, 15 years, 20 years, significantly outperformed the market. But I guess the question that I have is that changing your lifestyle? I mean, is it really being able to outperform the market 2 to 5 to 7% changing your lifestyle? We want to do it, no doubt about it. I mean, please don't get me wrong. We want to do that. But is that changing your lifestyle? So we're going to spend a lot of time talking about, what happens when the markets go down. Well, here's the bucket of money inside of your portfolio that is still going to generate positive returns. That if we see a period of time where the markets drop 10%, 15%, 20%, well, here's how you're still going to make money. So those are predefined outcome strategies, and there's a lot of them out there, and some are really great, some are really bad. But if you don't have predetermined outcome strategies inside of your portfolio, then you're just another client of an advisor that you're just going to track the market up, track the market down, and then you're at the mercy of chance of when you ultimately need that money. And that's something that, we're just not going to, that we're not comfortable with. And that's something you shouldn't be comfortable with either. So 630-492-1912, 630-492-1912. Give us a call. Let's have a conversation. Let's talk about the dinner in Naperville that we're having the end of January. It's going to be a 2-night dinner. Now, you only need to come to 1 night, but that is our tax strategy dinner. How can we reduce your taxable income? How can we, greatly reduce your taxable income while still being able to derive, strong, low double-digit, mid-double-digit distributions that are not directly dependent upon the stock and bond market? That's something we're going to spend a lot of time talking about this year. So if that is something that piques an interest, if you think you may have an interest in learning more about that, give us a call. Let's talk about what it is. We don't want to waste your time coming to a dinner that is complimentary, of course, but may not interest you. So 630-492-1912, 630-492-1912. So I want to make sure that, again, that no matter, whether it's inside your 401k, whether it's your IRAs or outside of, inside of taxable accounts, if you want to have strategies in place that can do well, whether the markets are up, down, or sideways, if you want to have a bucket of money that what we call it the defined outcome investing, so you can still make money when the markets are down, or still have 10% distributions or 12% distributions as long as the markets don't drop 30 or 40%. Those strategies exist. Some are good, some are bad. Those are the conversations that we want to have this year in 2024. So we are happy, and we look forward to just a great year. Hopefully, if you're not 100% convinced that your portfolio can handle market volatility, handle significant corrections, or if you just want to put more certainty around being able to make money when the markets are down, we're going to be a good group that you need to have a conversation with this year. So 630-492-1912, 630-492-1912. Give Paige a call. Let's have a conversation. We're excited about this year. We want to help you position your portfolio, again, to be able to make money whether the markets are up, down, or sideways. So we look forward to a great year. Again, give Paige a call, 630-492-1912. More next week.
Thank you for listening to Destination Retirement. Don't pay too much for taxes or retire without a sound retirement plan. For more information, please contact Robert Kuhn from Kuhn Capital Partners. Call 630-492-1912 or visit them online at kuhncp.com.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guests unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.